How do you calculate a company's intrinsic value? Imagine trying to find out what a company is really worth, not just what the stock market says. That's what calculating intrinsic value is all about. It's like peeling back the layers to see the true economic picture of a business. When traders and investors want to make smart decisions, understanding this helps them see if a stock is a bargain or overpriced. The main idea is to analyze what the company is worth based on its financial health and future potential. Market prices can bounce around because of investor feelings or news, but intrinsic value aims to show the real worth behind those swings. To do this, you look at the company's financial statements, cash flows, growth prospects, and risks. One popular way to estimate this is called discounted cash flow, or DCF. Here, you forecast how much cash the company will generate over the next 5 to 10 years. You then take each year's cash flow and discount it back to today's dollars using a rate that reflects the investment's risk. The formula is simple. The present value of each cash flow equals the cash flow divided by 1 plus the discount rate raised to the power of the year. You add all those discounted cash flows together, and that sum is the company's intrinsic value. Another method is the dividend discount model, which works well for companies that regularly pay dividends. You estimate the future dividends, then discount them back to today. If a company doesn't pay dividends, this method isn't as useful. There's also relative valuation, which compares the company to similar firms using ratios like price to earnings or price to book. If the ratios are lower than peers, the stock might be undervalued. Asset-based valuation adds up the company's assets and subtracts liabilities to find its net worth. This is straightforward but doesn't consider future earnings potential, so it's less useful for growing companies. To do a DCF calculation, start by estimating future cash flows for the next 5 to 10 years. Use past financial data, industry trends, and company guidance to make these estimates. Next, determine a terminal value, which is the value of all cash flows beyond your forecast period, assuming steady growth. Then, pick a discount rate, often the company's weighted average cost of capital, which reflects the overall risk. Discount all cash flows and the terminal value back to today's dollars. Finally, add everything up to get the intrinsic value per share. Some key terms to remember are free cash flow, which is cash left after supporting operations and maintaining assets. Discount rate, which accounts for risk and the time value of money. Terminal value, the estimate of future cash flows beyond your forecast. And weighted average cost of capital, which is the average rate of return required by investors. For traders, knowing a stock's intrinsic value helps decide whether to buy or sell. If the current market price is below the intrinsic value, it might be a good buy. If it's above, the stock could be overvalued. Options traders also use this concept to see if an option is in the money, meaning it has real value based on the stock's price versus the strike price. But remember, intrinsic value isn't exact. It depends on your assumptions about future growth, cash flows, and discount rates. Small changes can lead to big differences in the estimate. Market conditions and economic factors can also influence the actual value. In the end, calculating a company's intrinsic value is a key part of fundamental analysis. It helps traders and investors make more informed choices by focusing on what a company is truly worth, not just what the market says. Combining this with technical analysis and market sentiment can lead to better trading decisions.